Good afternoon, everyone, and I'm really pleased to welcome you all to the fifth and final webinar in this series on the topic of raising venture capital with impact. In this series, since the last 6 or 8 weeks, we have been exploring how entrepreneurs can successfully use impact measurement to raise funding from not only existing but also emerging venture capital funds. If you missed any of the first 4 webinars in the series, or you would like to watch them again, the good news is that you can catch up at the EIB Institute YouTube channel, where all recordings are available, including the one of today's webinar, later on in a couple of days. For those that are joining us for the first time, I am Luísa Ferreira and I'm Head of Social at European Investment Bank Institute. The EIB Institute is the philanthropic arm of the EIB, the EU Policy Bank, and support to social entrepreneurs and innovators is at the core of what we do. It is my pleasure to introduce you to today's speaker, Wladimir Nikoluk. And Wladimir is the founder and CEO of Atlas Metrics. Atlas Metrics develops technology to collect, manage, and report ESG data. In today's closing webinar, Vlad will walk us through the practical steps entrepreneurs must consider when they build their own impact measurement and management system, paying attention how they can use their data strategically to meet demands, not only from investors, but also from customers and employees. In this session, we'll also learn practical examples of best-in-class impact management systems of selected companies, and Wladimir will share with us some resources that entrepreneurs can use today to improve their own. With Wladimir, we have 2 very special guests. Hanna Leach. Hanna is a partner at Houghton Street Ventures, and we'll have Johannes Lenhard. He will be joining us in 5 minutes' time, and Johannes is the center coordinator of the Max Planck Cambridge Centre. Together, they are leading an effort in the UK venture capital space to make operational and environmental, social and governance and impact management standards. How will we organize? Wladimir will kick off the webinar with a presentation, and then we'll have also a short presentation by Hanna and Johannes, and then there will be a conversation between the 3 of them. So if you have any questions or any comments for any of the 3 of them, please type them in the Q&A box, and when you do so, please use the option send to all panelists. At the end of the webinar, I will ask you to answer a short survey, and thank you, and I now invite Wladimir, Hanna and Johannes to join us. The mic is yours.
Perfect. Thank you so much for that. It's a real pleasure to welcome everyone to this final webinar, and I just want to make sure that you can all hear me. I think that's probably the case, right? Yes. Great. So yes, my name is Wladimir Nikoluk, and this is the final webinar on the series on impact management. It's just a real pleasure to add to it, to kind of and welcome Hanna and Johannes to share their own perspective on how we actually operationalize a really important part of this whole ESG impact kind of nexus, specifically their work on ESG. Now, the way we're going to run today's session is that we're going to really first do a quick recap of the last 4 sessions. I will try to do it as quickly as possible, and then do a small deep dive on the impact management topic, on kind of the practical lessons and some best practices that might be helpful to you when you start thinking about and building your own impact management system. Then Hanna and Johannes will present the venture ESG approach, which is an incredibly interesting initiative within the UK VC capital ecosystem, but also I think applicable way more broadly to create the ESG, a common ESG standard. And then we'll have a deep dive in the conversation on selected topics like, what is the cost of actually running an ESG and impact management system? How do you standardize ESG and impact indicators, as there are so many kind of competing and different ways to look at it? What are the benefits and risks of actually running such a system? And what would be the advice for aspiring entrepreneurs after all of this? So just a very quick recap. How do we think about, what like impact and this nexus, this intersection of impact and finance? We can kind of think about this in the highest maybe terms to say, well, if you truly want to link impact and finance, it should be something like a genuine form of impact investing. So this idea to generate financial returns, but also at the same time measurable positive social and environmental returns. And this is kind of a little bit different from some of the terms that you would see flying kind of around, LinkedIn posts. You would see things like negative screens, which would just exclude industries that are kind of considered sins. It would also go a little bit beyond maybe some form of ESG integration that you see in financial markets. So it's really like, this kind of subset of capital that has both those ends in mind. And one of the most important reasons that impact investing is actually taking off is in a way the imperfection of our world. I think our economic system has served us remarkably well for centuries and has improved a lot of kind of social indicators, but it seems that now we are reaching at a tipping point where our economic system produces a lot of headaches, and perhaps even more headaches than it actually benefits us. And so this creates, in a way, demand for impactful services, right? When we see the CO2 concentration rising, when we see sea levels rising, when we see an unsustainable demand of resources in terms of our planet, when we see income inequality, mental health, an unequal distribution of kind of health resources in general, it might be time to think about, scalable solutions to some of the problems that we see in the world. And the way our common language, in a way, to speak about a desirable future that we as a world agreed on is still very much the SDGs. And they are in kind of different degrees related to a lot of frameworks that you will see within small organizations, but also like public, regulatory or investor-led frameworks. And one of the most interesting emerging patterns is that you see this form of impact entrepreneurship really kind of taking off, right? So it used to be that the most successful companies or that they would either do finance, or like financial return, or they would be like NGOs and really try to kind of influence an SDG indicator. But some companies have really shown that you can do both. You can build a really successful and valuable business while doing a lot of good in the world. And we've looked at some examples like Zipline, Indigo, and Andela. And we try to understand a little bit the perspective of VCs on all of this. And one potential story that you could tell is that, you have this financing gap in terms of the SDGs. It's really huge, and it's clear that the current resources in the social and public sector are just not enough to fill it, right? So there is demand for products that are scalable and that have impact in a way to solve those SDG issues. And then you also have a surge in global talent. It's just the fact that millennials and younger generations seem to have a preference set that is quite clearly focused on impact, both in terms of how they work, but also in terms of how they consume and how they invest. So from an investor's perspective, that's good, because you now have some really bright teams building some of those scalable solutions. And lastly, I think what we see is that along different stages of company funding, there is an over demand and undersupply of genuine impact assets. If you're in the private equity space, sometimes it's really difficult to find those kind of impactful companies. And so investors who can at a very early stage build genuine impact assets would be able to charge a premium down the line. And this has led us to think about, okay, what were the reactions in the VC space? Partially it was just coming up with completely new funds, impact funds, and partially it was about creating verticals within existing traditional funds to just focus on impact topics. And in one of our sessions, we just explored those traditional funds that create new verticals. So what is their perspective on all of it? And I think it was quite a sobering lesson that we learned, which is that for them, a lot is not about impact itself, but impact is just like a trend, like AI and maybe blockchain, that can be harnessed to build profitable companies. But in a way, those traditional funds will not cut you any slack just for having impact. And the reason for that is that they are really careful. There used to be an impact, in a way, an ESG perhaps focused boom in around 2008. But the history has shown that despite of this kind of huge interest and huge investments that were made, the kind of companies, specifically if you look a little bit at clean tech, really didn't outperform all other investment classes. So right now, those traditional investors that are kind of have been around for long enough, they are kind of equally, kind of skeptical about the current investment processes, and as a result, they have the same kind of high standards for impact companies as for non-impact companies. And that, I think, is really different from some of the impact funds we saw in other sessions. In comparison to traditional funds who kind of focus on ESG and focus more on aligning the metrics and trying to find a common language and standardize indicators to find really common ground, impact focus VCs think that ESG is really not enough, that impact indicators need to be understood to really assess whether a company is actually doing something good in the world, and those kind of relationships between output and outcomes really need to be quantified, both in terms of the projected impact, but also in terms of just the mindset of the founder, right? Like, why is actually someone in this game? And this led us, I think, to a really important discussion about like what's actually the difference between ESG and impact. I'm sure Hanna there's so many different ways to kind of talk about this, but like one helpful way for me has always been kind of to think about the leading question for both of them. And so for me, the leading question in ESG is really like, are you a responsible organization, right? Like in terms of where you source your products, how you treat your workers, how the communities are affected by the supply chains that run through them, everything that you need to do before your product is kind of ready for consumption. How responsible are you, right? And this can pertain to pollution, diversity, product safety, corruption, and other things. And then impact is really, to me, what happens as a result of consuming your products to different stakeholders. When you think about, the health of your customers, how does that change? The education levels, maybe the incomes. Does your product, is it able to do carbon sequestration? Can you generate access to capital for other people? So those are really impact focused metrics. And I think one of the key differences is, for example, that in ESG, theoretically, you could be a tobacco company. You could have really high ESG scores, and some of them actually do. And at the same time, it's clear that they're consuming, obviously, cigarettes is not really the best thing on the impact. Then we looked at 3 key concepts for impact management, and I will jump straight to impact management because Hanna and Johannes have so much more to say about ESG. And so on the impact management side, I think it's really important to understand 3 concepts. So one is the theory of change, right? We discussed the logic, essentially by which your company seeks to influence the world, hopefully for the better. And here you should just really write down what inputs do you have, what do you do with those inputs, what outputs do you produce, like what change in the world do you expect as a result of those outputs, and what higher level goal in terms of maybe SDG is ultimately the impact of your goods and services. And then the second thing is, we discussed that out of this theory of change, really the core relationship you need to focus on is the output and outcome indicator, right? So if you're an education company and you want to, for example, educate people about, you want to give, say, vocational training, your output is number of people trained in your program, but the reason you're doing it is for someone to find maybe a job, right, or earn a higher salary. So this outcome level is just really, really important to understand. It's not enough to report how many people you trained. It's really important to kind of figure out whether, as a result of your training, the probability of finding a job or the salary increase actually improved. And the last thing is, correlation is not causation, right? So we talked about counterfactuals and additionality, and this idea that, it might be that as a result of your program, some people actually earn a higher wage, but that might not be because of your program. So you need to figure out, in the best case, and that's sometimes very difficult, but sometimes you just need to think about how much additional value did you actually generate, given all the other things that would have naturally happened with a certain person. Maybe they would have found a job without you as well. So can you really attribute that job finding to your program? And then we looked at some very specific impact management approaches. So we looked at bridge spans, impact multiple of money. To me, this is one of the cleanest ways, I think, to create some form of impact projections fairly quickly and reliably. So the way it works is really, it takes advantage of some of the key concepts that we discussed earlier, right? So you have a certain output and you have a certain outcome, and that creates a certain impact in the world. And you try to quantify it, right? Like, what's the value of someone finding a job 1 year earlier, right? Or what's the value of getting a microfinance loan to a startup in terms of the impact on the community or in terms of the impact on the families that it solves. So being able to quantify that output and outcome relationship gives you a really nice way to then just overlay that logic with your sales trajectory and then have some form of impact estimate to what it will actually mean as your company grows, right, for the world. And if you have any questions, I'm happy to kind of dive into this more granularly. And then we looked at another framework, and this was tangentially mentioned by the Reimagine Bank, so the IMP, the Impact Management Project. And here, it goes really a little bit beyond, right? The IMM, in the end, it gives you a dollar value, right? Or maybe a dollar versus a dollar ratio. And for the impact multiple of money, it's much more qualitative discussion. So first, you kind of want to understand essentially the impact of your products and services along, these 3 dimensions. Do you avoid harm? Do you actually benefit someone? And do you contribute kind of to system level change? And you want to understand those 3 questions on several dimensions. So, what do you exactly do? Who do you serve? Specifically, are those people underserved maybe and wouldn't get otherwise the attention that they needed? How great is your impact? What actually is your own contribution? And what are the risks involved maybe when actually deploying your product? And so as a result, you could actually now kind of take a company and you can kind of start taking it apart, right? And you have this like much more granular view of the way it thinks about its own impact. You take a healthcare company and you say, okay, so what's on the act to avoid harm dimension, right? Like what really happens? And you could say, well, it's just true that we as a company have CO2 emissions, and that's actually bad, right? And you run through the dimensions. And on the other hand, on the output dimension, you actually serve people as a healthcare company. So this really provides a benefit to the stakeholders. And then you also, on the contributing to societal solutions, you as a company can actually be a lighthouse for a company that actually pays workers way more. And maybe that will incentivize other people to actually pay them more as well. And that would solve this system level problem that healthcare workers are underpaid. And so in a way, you can start thinking about, once you have done your IMM, you can actually look at the IMP and say, like, okay, can we give a much more fuller account of our impact in this kind of manner? But there are so many more frameworks as well. You could do a life cycle analysis for your product, and you could do the AIM framework of the IFC. There is the ROSE framework. There is the Venture ESG framework. There are so many of them. And so I think for you, it's just really important to figure out what do your stakeholders really demand from either investors or customers or your employees, and then find a really kind of intuitive way to solve it. What is really important, I think, to keep in mind is that ESG and impact are not they're not contradictory. To me, they're highly complementary concepts essentially. And you can kind of see that by just considering the leading questions with regards to certain stakeholders, right? So are you a responsible organization? And what's the kind of, how does the world change as a result of consuming your product, right? And if you look at, for example, your employees, right? They will really care about whether you are responsible and whether the product that they help to create is actually good for the world, right? So if you are competing for talent and you want to attract and retain and motivate talent, it's really good to have both of those components. In terms of your customers, if you want to increase revenues and customer loyalty, it's really good to answer those questions in a convincing manner. In terms of your investors, to ensure that you have access to capital and that the cost of capital is actually low, especially when you at some point are big enough to apply for something like ESG loans, where your interest rate depends on the ESG rate, or whether you apply for impact funds, that will not give you capital unless you have like an impact theory of change system. Again, this is a really important concept to have. And then, of course, regulators. There's more and more regulation coming at you, especially as you grow. And it can be really a competitive advantage if you manage ESG and impact from the beginning. I think lastly, what I would like to point out is that it's really important to start building the system early and kind of in a sustainable manner. If you look at the growth stages of a company, in a way, reporting requirements keep increasing for you, right? Like if you start early on the kind of seed or pre-seed stage, you have like, 10 employees, 15 employees, you probably have maybe like maximum one VC-led framework, right? So here it would make sense to have 10 indicators on the key dimensions that are important to you and start already reporting them. When you reach Series A, there will be other frameworks that might be relevant to you. Those are still optional, But if you do them early, you can in a way harness the benefits of them, and you know that you need to do them anyway as you grow. When you reach Series B and C and you are kind of like around 250 employees, suddenly like regulation, like the EU taxonomy will become relevant to you. And it's here at the latest where a lot of those indicators actually need to be reported. And if you've done a lot of the work previously, it will not be such a heavy lift as it will be when you have to do it completely from scratch. And then it just keeps adding up, right? Like as you grow further, you will have like national supply chain laws, which will ask you essentially about the human and labor rights risk around your supply chains. And then at some point you IPO, and there will be this plethora of frameworks like SASB, GRI, CDP, which will again like be a more just more reporting burden for you. So there is this kind of vision that you could have for your system where you know that this will not go away, and you can kind of build already a core of it and keep expanding the core in terms of sophistication and breadth over time. So in terms of best practices, you should understand and implement kind of the key concepts of impact management. You should strive to create a core ESG and impact management system early. You should use ESG and impact data strategically with your key stakeholders. You should continuously increase the sophistication of your system. And I think at some point it might make sense to find a good time to move towards a digital tool that will help you to automate and professionalize this process, especially as you kind of grow. So with that kind of basis and kind of like quick detour around impact management, I'm absolutely excited to have Hanna and Johannes share and kind of complement and correct some of the things that were presented with their work on ESG. So yeah, the stage is yours, guys.
Brilliant, thanks, Vlad. I'm just going to share my screen. Hang on. Oh, sorry. Can everyone see that?
Yep. It's not full screen though, I think.
Hang on. Mine. How's that?
That's perfect.
Okay. Johannes, over to you.
Yeah, Vlad already did the first slide, I believe. Thinking about what the difference between ESG and impact is, with a specific focus on us now diving into what VCs can do when it comes to ESG. I think it does make sense to very, very bluntly state, I think this is our way of thinking about this. There's various different ways out there which make sense. And the most important thing that I think the takeaway from what you said, Vlad, is absolutely true. They're absolutely not exclusive. They do overlap. They're complementary. What you do not want to think though is that anyone who says they care about impact or they're an impact investor has already thought through all the ESG considerations. So that's, I think, one of the biggest pitfalls that lots of impact investors don't have, but some people that think about impact investors might have about impact investors. So all of that to say, for us, ESG is really focused on the process. We are looking at, in a sense, everything any company does internally mostly, and how they go about their daily business, right? How are they running their operations? How are they hiring? How are they developing their product? And Hanna is going to get into detail when it comes to 8 different specific areas that we cut this into. While impact is really looking at outcomes. So if you're thinking about this, what some people call the kind of impact lockstep model, where the business as such is set up with a specific impact, say, measuring your environmental footprint in mind, and every kind of bit that the business grows also adds to the impact, right? So the bigger your business becomes, the bigger your impact is going to be. And this is really always focused on some kind of an outcome that's external to you as a business. Very extremely speaking, you can still not be, quote unquote, following ESG principles and still be impactful when it comes to this, right? You can still not think about the diversity of your board or your management team and still focus on environmental impact. So just keep that in mind going through the rest of these slides of what we mean when we say ESG, basically. If we're going to the next slide, just a brief view on the history of ESG for venture capital. So ESG was actually coined as a term in 2005 with a working paper that the UNPRI was involved in. And it has taken until about 18 months ago or so when the term first started popping up in conversations around venture capital, right? While specifically around the turn of the 2000s after the financial crisis, impact became bigger in public equities. What happened in the VC world is that it's really been lagging behind. But that has changed in the last year or so, in the last year, a couple of years perhaps. And some of the reasons are listed here. I think one of the big reasons that we've seen is that more and more VCs are now younger, care more about the environment themselves. They hire people in as employees, as investors that are of a similar type, and what some people call LOHAS, so concerned with sustainability in their own life as well as in the work that they do. And similarly, the founders tend to be more of that generation, right? So you end up having to deal with a workforce, people that you invest in, and more now also GPs like Hanna that really don't want to do investments into businesses that have no considerations for these factors that we're talking about. And the same is becoming truer for some of the LPs, so the limited partners that actually are the asset owners of the capital. There's more public pressure on them for the same reasons, right? The consumers care more, the employees care more, the investors care more, to actually say the most well-known example is divest from fossil fuels, right? But this is now becoming more comprehensive, and there's a bigger movement towards embracing ESG considerations more widely. And then all of this together has in the last 5 years or so increasingly led to scrutiny of big tech companies, right? You only need to mention anything from Theranos to Uber to WeWork to recently Deliveroo to understand people do think about what these people in the big tech organizations do now, increasingly so, right? Big tech had a moment the 10 years before that when they could do more or less whatever they want. They were celebrated as the new saviors of the world, solving all of our issues. And we recently have woken up to, that's not exactly what's been happening. And that backlash is only starting now to shoot through to the venture community. And again, the next generation of founders, the next generation of investors is thinking about this differently. And that is partly because there's increasingly what is often called business case for ESG, right? This starts to make more and more, and the research is backing that when it comes to certain subsections, for instance, D&I and the environment, it starts to make financial sense. So this whole argument about the fiduciary duty, which we're still hearing in the US, where funds and limited partners say, this might be a distraction for my GPs and for my investments. They just need to make me money, is increasingly actually caught up in this conversation around, yeah, but they will make you less money if they don't think about this. Right? So there is a moment now to actually really double down on this and think through how this can look like. And that's why we're doing what we're doing.
So yeah, as Johannes said, that's why we're doing what we're doing, which is trying to drive engagement around ESG within the VC and the startup community to get VCs to start thinking about how they can integrate ESG, or if they are doing it already, how they can better integrate ESG comprehensively within their fund, and also within their investment activities, and also the way that they support their companies. So, you know, as Johannes said, it's not just kind of on D&I and environmental impact, but it's looking at across the board, everything that happens internally within a company. And at the moment, you know, if you're a startup or you're a fund and you're looking for guidance or toolkits as to how to do this, there won't be a lot of advice out there because, you know, as Johannes said, VC has been very late to this. So there are lots of frameworks that exist in public markets and late stage private markets. And, you know, here we've got the B Corp, which I'm sure you've heard about in this series already. But a lot of what these frameworks cover are not fit for purpose for venture or for early stage companies, and they don't tackle the risks and the challenges and the issues that early stage companies face. So specifically around business models that change and pivot, really new technologies, products that are developed rapidly at a rate of knots, and also really fast growing teams. So we've started putting together this new approach and new framework that takes the best of what's out there from the established ESG world and has supplemented it with things that are relevant for early stage companies and venture. And one of the pushbacks we often get from funds is, or companies, is that seed stage companies are too young to think about ESG. And I think actually Vlad's slide a few slides ago said that if you're pre-seed or seed, you don't need to think about ESG. But for us, it's we don't feel that's the case. You don't necessarily have to take active steps straight away if you're super early, but you should definitely be thinking about ESG, thinking about how you're going to build your team in a diverse, inclusive way, how you're looking and considering the adverse impacts of your business and mitigating those. Like, it should be part of the way that you think about building your company. The later you start to do this, it's much harder to change and introduce new practices. And a lot of building a responsible business comes down to the culture of the company you're creating. And as we all know, we've worked in companies where the culture hasn't been great. Culture is very hard to change once it's set in stone and once it's taken shape. So in order to set that tone from the beginning, you need to embed ESG as part of your the values of the company and its mission. Startups are also not immune to risks by any stretch of the imagination. Any reputational damage can kind of destroy them in one fell swoop, not only affecting your ability to raise money, but it can destroy consumer trust, and it can really ward off any top talent or any talent from wanting to work with you. And a good example of this is around GDPR or data privacy and security. Not handling consumer data in the right way. If there's any breach, that can destroy consumer trust straight away. So on the risk side, there are some things that you have to think about from the moment that you start operating. And also, the earlier you do it, the earlier you're going to be able to drive your growth. Not only on the customer side, as Johannes said, as younger generations start to care more about this in the products and services they're buying, but increasingly people want to work for companies that reflect their values. It also helps in terms of new market entry if you're aware of the local regulation, and it can be a differentiator for investment too. So there are a number of simple steps you can take to integrate this into the very fabric of your company. So as we've said, we've been designing this new framework, and we've broken it down into 8 issue areas, which are slightly easier to understand, because obviously when you're talking to a founder, using the terminology ESG isn't particularly founder friendly. It probably causes a lot of founders to kind of bristle, and it's not very relatable. So we've broken it down into these areas. So DEI, team and working environment, which looks at everything around culture and how to incentivize and be a kind of a conscientious employer. Environmental impact, supply chain, data privacy and security, building responsible products, which isn't something that is captured in a lot of other frameworks, the legal and regulatory side of things, and good corporate governance. So here, I think, how can you actually, as an early stage company, start to make progress on ESG? Like, what does it mean for you? We haven't gone through the full framework because it's quite long and extensive, and we're going through the process at the moment of applying a materiality lens, so we understand, given a company's stage and their size and their sector, and we have a better idea of what things are a real priority for them at that point in time. But here are just some, we've taken out 3 examples around DEI, environmental impact, and responsible product design. So if you're looking at DEI in your very early stage, what can you do from the get-go? As soon as you receive investment, you're going to be hiring, and you should be doing that in a diverse way. So making sure that you're putting in the proper mechanisms to enable you to source and appeal to diverse candidates. So that can be as simple as putting a DEI statement on a job description and using inclusive language, and there are tools that you can put your job descriptions through that will assess like the language you're using and whether you should change it. You should make sure that you assign an internal DEI champion, even if you're a very small team. Giving someone responsibility for that and then kind of holding them accountable to certain targets and goals is really important. And then another simple thing you can do is implementing a non-discrimination policy. The key is with policies is to make sure that you actually act and perform against the policy and not just have a policy for policy's sake, but a policy is a decent starting point. And then in terms of measuring things, we always say that, you know, if you're going to implement something, make sure you measure it too. So you can measure the diversity of your team from the get-go. You know, that could be across teams, that could be from your advisory board. And also you can easily measure the pay gap. In terms of examples, we'll share these slides and include the links, but you know, Gusto and Zalando are very good examples of making a commitment to DEI from a very early stage. And there are some fantastic resources out there. We've just listed a few of the organizations that you might want to look into. On the environmental impact front, thinking through what is your biggest contributor to your environmental footprint. It's almost like an environmental audit. So everything from your operations, your supply chain, your the end-to-end of your business. And then from that, if you've ascertained which is the biggest impact, you can then look to take steps to how you can deal with that. And then some very simple things is switch to a clean energy provider, offset team carbon emissions, and implement a team travel policy. Again, these are simple steps. In terms of measuring, you should really read up about the scopes 1 to 3 and what they mean. And if you're going to measure anything, you know, really look at measuring scope 3. So that's everything from your employee travel right the way through to the impact of a product or service. So if you're a gaming company, your potential impact on the use of your product could be quite high. Examples, WeTransfer has been very public about their climate neutral journey. It has a lot of material online about how they got there, so that's good to look at. And then there are increasingly a number of platforms that are coming out to enable you to measure your carbon footprint, and companies are being very transparent and open about how they've gone through this process. So Allbirds has recently released their carbon footprint calculator, as has, if I'm not wrong, Klarna recently. So they would be 2 ones to look into. And then the third one is responsible product design. So this isn't something that people tend to talk about, but it is extremely, extremely important, and it does actually relate quite nicely or interestingly to the impact conversation. So this is really thinking through all of the possible unintended consequences of your product and what can be done to mitigate it. And further, how accessible and inclusive is your product and what could be affecting this? So this could be anything from the diversity of your product team or any inherent bias. This is a big area to look into, and we recommend that you kind of look at .everyone's consequence scanning process and all of the work they've done, because it's really interesting. In terms of measuring stuff here, there's it's not so much tracking a metric. There's not a quantitative process. It's more just making sure that on a frequent basis you are reviewing and actually documenting the unintended consequences and how you're mitigating them. A good example to read up is Bethnal Green Ventures, which is a UK impact fund. One of their portfolio companies noted one of their adverse impacts was that their product was leading to increased screen time. They then thought about mitigating it and introduced in-app prompts to stop that. So definitely recommend reading their report, which is just a fantastic resource on how they've approached impact generally. I think what a lot of these things demonstrate, and maybe a difference from impact, is that a lot of much of the ESG work done at a startup or venture stage is still quite nascent, and a lot of it at the very early stage isn't measurable. There isn't an associated metric, you can't quantify it. A lot of it, I think, as Johannes might have mentioned, is more around intentionality of a founder. How are they thinking about building their company? How are they approaching it? How are they tackling it? And whilst it is important to measure what you can, it's more important to make sure that you are repeatedly and frequently having those conversations about a lot of these issues. I'm now going to hand back to Johannes to go through some do's and don'ts on ESG.
Yeah, and I think picking up from Hanna's point just now, the intuition which some people in the market have, and some of you might share, to boiling this down as much as possible, ideally to a number or one letter or three letters, the typical AAA kind of rating, at least at this stage, very likely going forward, is completely mistaken. I think there's anyone who does that, to me, is losing this from the get-go, because I think you're missing out all of the complicated conversations, and that's really what it is, and what Hanna just said, that you need to have. There is work involved, and you won't get around this by assigning a score. So that, from our perspective, I think is quite a big don't. You don't want this to be a reactive compliance reporting exercise where you send out a spreadsheet, people send it back, and that's it. This should be a conversation that is actually spurring action to change things in your organization, which ultimately are going to make it more resilient and more sustainable and just a better business going forward, right? That's really the belief that we share. And also very directly counteracts any idea of impact washing, greenwashing, whitewashing, whatever you want to call it, right? Which we are seeing increasingly with the head of impact, or I think was called the head of sustainability from BlackRock, stepping forward 4 weeks ago, and various different campaigns of buyout funds being called out for, wait, are you really claiming that you're ESG principled or impact focused, and have all of these things not in place or in place that really counteract that to begin with? So we're already seeing in bigger funds and for bigger assets that there's a lot of this happening. And I don't think we want to repeat these problems, because that then takes us to a point that we've been at with corporate social responsibility and continue to be at for the last decades, actually. And at the same time, also following from what Hanna just said, this is a moving target. Don't try and do this all at once. Set yourself specific goals. Nobody says that you need to do this right now, all the time, immediately. Give yourself a focus area or two, and start by going one by one through the different questions and processes, right? Particularly when you're an early stage startup, nobody is going to require you to immediately score without a score highly on all of this, right? This should ultimately be within your values, within your culture, which does not just mean we need top executive focus on this, but really this should be a conversation that everyone is involved in. And really, again, you need to identify the priority areas that are relevant for you, right? Some people would call this materiality lens, but in the end, again, there's a conversation behind this where you need to figure out what matters at your stage of the company and in your industry and for your very specific focus, right? And all of this should be married with assigning responsibility. And this can't just be the CEO saying, oh, I'll do this as well. That's likely not going to be good enough. You very, very likely want to assign at least part of a person's responsibility towards this, or a subsection of this, right? In the US, what we're seeing a lot of is that there is now people responsible for diversity and inclusion specifically. What I think increasingly we're going to see is that there are going to be people, and a good friend of mine just started as head of sustainability at TIA. These positions are coming up now more and more as these companies are waking up to this, scaling up. And ultimately what this community venture ESG is about is this very last point, share. We do not believe at all that this is going to be a factor that will differentiate you in the market. this is going to be how you are going to do business in the next decade. This is possibly something that is differentiating you right now. You can be a leader in this and you can be better than most others at the very moment, but there's going to be a harmonization which is going to be pushed, as we said before, by regulation, by the LPs, by the investors, by your peers. So you should get onto this train right now, but don't see it as a differentiating factor. So trying to make this as concrete as possible, I think. We can now go into some questions.
Amazing, guys. Thank you so much. I think this was exactly the practical and operational reality check that was kind of the missing piece in the series. So I'm just grateful that you contributed it. Maybe before we jump into kind of the questions that we also had from the audience, a couple from our side. So maybe just to play a little bit devil's advocate, right? Like the ESG, the overall kind of theory of change that kind of I think we all agree on, but that also someone might not agree with, right? Is that having those conversations is actually something that will make a company more resilient, more prosperous, give it a stronger culture, and so on and so forth. One interesting example in the last kind of weeks was a Basecamp, right, which actually banned discussions about social good on its on politics on its kind of like corporate channels, right? It says like you're free to do whatever you want in your kind of spare time, but then talk about politics and kind of inclusion and all of that stuff is a little bit distracting, and we think it's just unproductive for our company. Like, what would you as kind of ESG experts make of that?
I mean, that goes immediately against what I just said, right? This should be a conversation and not a reporting exercise or a compliance question, right? And ultimately, I think this idea that you should ban any kind of conversation from being voiced on corporate channel is ultimately a question of how much do you really care about how your employees are involved in your business, think about things. Ultimately, this is a way of silencing the organization, right? Which I fundamentally don't agree with from an ESG perspective, but also from a democracy and the Americans should come in and say freedom of speech scream perspective, right? And obviously they say, oh, but this is a corporate room space that we control, and this should be about work and not about politics. But I think this is a dangerous point that prevents progress. And that's exactly to go back to another example. If you're reading about Uber, that's exactly what happened there without it ever being a policy, from what I understand. But there was just such an overwhelming majority of what Emily Chang called bros in the room that there was no conversation, or there couldn't really be a conversation about sexism and not only sexism, actually sexual assaults within the company, to a point where there was no procedure where people could complain, right? So that's another very extreme example of what this can lead to, I think.
Mm-hmm.
Yeah, I would just reiterate, I don't think it leads to it doesn't lead at all to a inclusive culture where people feel like their voices are heard, and that process is very inherent to building a culture where people feel like they belong regardless of where they are or what their beliefs are. So I would say that's fairly anti, our approach.
So got you. Maybe turning into this kind of question of like, what does it actually take operationally to run the system? So, and maybe one small correction. I actually agree with you, Hanna, 100% that we should think about this very early on. And maybe just to be also clear to the audience, I think the slide, what I meant with the slide when it said optional was that it's just not required by law, but obviously there's a lot of reason to do something even before a law requires it. But having said that, right, like whether it's impact or whether it's ESG, having those kind of conversations, investing kind of the resources, calculating your scope 1, scope 2. I mean, scope 3 is something that can be incredibly intensive as a task, depending on kind of the supply chain you have. That all seems to kind of take resources to some extent. How do you kind of like, what would be kind of something that you would address when a young startup says, well, we don't even have the resources to run our daily business, and we kind of, we're struggling with that. Like, how expensive is it to run the system? How many like FTEs do you need? Like what's roughly the cost to do that?
I think it's changing the way in which ESG is perceived within a business. It's not an add-on. You know, if everyday part of your business, you're going to be building products. That's just part and parcel of you're doing your everyday job. Like you're hiring, you should be hiring in an inclusive way. It's not like, oh, this is an added thing I need to do. I need to like go and source from, you know, other pools of candidates. Like it's actually just part and parcel of what should become essential operations for a business. I think it's when we see it as an add-on that it becomes something that we don't have time for, if that makes sense.
Got you. So and do you expect that if, like, for example, if someone like now sees this webinar and they are like, well, this is what I've been waiting for. Venture ESG is here. I'd love to do this now. Do they need to expect to kind of have to invest additional resources to implement it at the organization? Or do you see, no, it's just, there's no additional cost in a way to having those conversations and doing those analyses?
So we spoke to someone the other day who said that if you're really committed to your climate and your environmental footprint, you should just make sure you have a line item for that. And I think it's naive to think that it's not going to be an additional cost. I think it's sometimes the shortcuts are the worst thing. So, you know, saying, oh, I'm just going to hire my mate who I'm friends with, who I went to uni with, who I know is free. Like that's a shortcut. You should probably invest in doing things better. It will take a bit probably more money, but the benefit in the long term is there. But I think initiatives like ours and other initiatives like Rose are trying to get to a point where we can give resources and make resources available for funds and for companies so that they can easily access, you know, I mentioned the D&I statement and, you know, platforms from which they can source from, and those tools and consultants. Like if we can create that system where all of that knowledge is easily accessible, then it won't be so hard for startups.
Makes sense. And is there like a rough, maybe then if it does cost a little bit of additional resource, is it like a rough estimate of how much additional resources is required, or will that differ a lot from company to company and kind of company stage?
Well, going back to what I said before, I don't think it's additional resource. I just think it's the time that, you know, you're a person who owns HR. Johannes, maybe you need to help me articulate this, but I don't think it's necessarily should be seen as an added cost. I think it should just be part and part. Yeah.
So there's two ways of addressing this, which is cut into different points in time. Right now, because we don't actually have figured out how this works, you will likely have to invest time in order to do this, right? And that means both time at the VC fund, who will then help the startups. There's actually an opportunity here to really be value add as a VC for once. So I see a big point here where there's going to be more exchange where the VCs can actually support what's happening in the startups and take some of the time that they will steal from the startup by asking them some additional questions, kind of paying that back by saying, oh, but we can actually support you, increasing your thinking about D&I and helping you with your environmental footprint measurement and stuff. Going forward, I think what Hanna is trying to articulate is there's going to be a different way of doing stuff. That's the idea, right? This is not an additional thing I need to do. This is how I'm doing hiring. I've been doing hiring wrong, right? I need to do this differently, right? I need to write my job description differently. What I have been doing so far is attracting not the ideal talent, right? And we always talk about this business case, and that's true. But also, we're increasingly, I've spoken to a couple of impact investors, so my answer might be colored by that. We're increasingly facing a world where making a couple of £1,000 more or less won't cut it anymore. Actually, it's fine to spend thousands of pounds on really thinking through whether you are environmentally friendly or not, because our world is going down, right? So I increasingly am thinking there doesn't have to be a penny-based business case for everything. This is doing business better, and we should all embrace this.
Yeah, makes complete sense. And now moving on to this kind of audience question. So one of the things you said is like, well, not everything can be broken down into quantified kind of metrics. Sometimes like the discussion itself is worth having and has this kind of maybe non-quantifiable benefits as well. There was a question from the audience about like, you know, how can you hold then people and companies accountable without bringing this kind of measuring or scoring methodology in there? And then how, especially in the absence of those kind of numbers, how do you avoid greenwashing and yeah, just making sure people actually focus on authentically delivering it?
I think there's a slight, we're not saying that things shouldn't be tracked and you shouldn't set targets, but I think a lot of lots of things at the early stage, you can't necessarily associate a quantifiable metric to them. So we're not saying that there shouldn't be reporting. We're just saying that, you know, you're not going to be assigned a score of 4 out of 5 because that becomes actually quite arbitrary. And we actually think that that scoring methodology actually leads to greenwashing, because at the end of the day, they just get assigned a score and there's nothing else that comes from it. You know, so a company actually understanding the reason why they might have scored a 1 out of 5 or a 3 out of 5 is way more interesting and insightful as to their approach and what they tried and what worked and what didn't, as opposed to just having a score. So I think maybe it was a mistake in the way we communicated it. Like, we don't think that there shouldn't be targets and that there shouldn't be reporting. It's just shouldn't be reduced to a simple number.
Gotcha. And I think there's a lot of evidence to suggest that sometimes those numbers are not that reliable, right? I think especially in public markets, the correlation between the ESG ratings is just really, I think it's just 0.3, which is fairly low. So maybe then kind of another question that was also asked is this idea of to what extent is ESG in a way performance to some extent, or like just all of those ESG considerations being an integral part of the considerations of VCs when they kind of have to decide whether or not to invest in a company, right? Like when you say it's going to be ubiquitous and everyone will do it, will it be like a necessary condition almost? Do you think there's a continuous variable where they kind of track the ESG performance and in a way that informs their decision whether to invest? Or like, how do you see this play out in terms of VC decisions?
It's one for you, Johannes.
There's a divergence, I think, in the question as well between ESG and impact, right? This idea of solving big problems is, I would like to park because that's a different question, which is massive and very problematic, because he's absolutely right, and lots of funds would agree on that. We are building products on discretionary income, right? Basically, what the question here is about. But that's a different conversation. I think the idea that ESG is influencing VC decision making on investments at the moment, we're not there yet. There's some considerations that surely will, but it's more of a red flaggy type situation where, they're really not thinking at all about A, B, C, D, and that actually will have a financial impact quickly, because the VC decision making kind of lifetime is just about 10 years. Right? And that's slightly disconnected with how quickly they can make money from it at some point. But that's the situation at the moment. And what we are seeing with some of these Deliveroo, Uber, WeWorks of this world panning out the way they do, which really is already very material. These VCs will have made shit tons of money, but they won't have made the money that they could have made if some of these considerations would have led to slightly different constructed companies before the IPO. The WeWork IPO would have likely happened if the ESG principles would have had any impact on this company, right? And then many more people would have made much more money. Not to say that that would have been great, but there's definitely more and more illumination here now that not necessarily always immediately in the investment process, because I don't think you can foresee everything here, right? We are still talking about a reasonably long time horizon from seed investor like Hanna coming into a WeWork to WeWork IPOing, but you can do a lot in the meantime, right? And that again takes us back to what you basically said, but there's going to be a continuous reiteration of what ESG means for a particular company A, how you're thinking about this and how you're changing how you're going to go about this in your actual day-to-day practice.
Fantastic. I'm just conscious that we unfortunately are running out of time. We might have already run out of time, but maybe just to help the entrepreneurs, like, could you just help them understand where they could access your resources, and you know, maybe also post a link into the chat for everyone who kind of wants to take a closer look at it afterwards.
We can share the deck with you, which has the links. Currently, the venture ESG community doesn't have a publicly available website, but that should change in time.
That's how moving the target is.
Yeah.
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 The short answer is that there's very little out there in general about ESG for venture capital, and the best two papers we can share with you that we're always sharing.
Perfect.
And then going forward, you will be able to actually find more on venture ESG as a platform and community as well. Within weeks, this is imminent.
Okay, perfect. Well, thank you so much, guys. This has been incredibly interesting. Thank you for pushing the ESG topic. I think it's one of the most enlightened and illuminating kind of perspectives we had here so far. So I'm just grateful for you taking the time, and also just grateful to Luisa and the EIB to creating a platform to speak about all of those issues and actually take stock a little bit where we are and what we've done already, and also all the work ahead. So thank you all for being with us today.
Thanks so much for having us.
Thank you for having us.
Thank you both to Wladimir and Hanna and Johannes. And I would just like to thank you for being with us. And as I said in the beginning, there's a survey to answer. And if you want to recap any of the 5 webinars on the venture capital, raising venture capital with impact, go to our YouTube channel and stay tuned for the next webinars on different topics. Thank you and wish you all a nice evening. Bye-bye.
Hey, thanks.